Hi everyone, I'm Kevin from Bitcoin for Beginners, and today I have a special video for you guys. I'm here with Zach from TokenTax. So if you're a crypto trader or investor and you might have found yourself in a slightly more complex situation than just a normal, like you're on Coinbase and Binance and that's it, then this video for you, because we're gonna dive into a lot of different topics, and I'm gonna also leave timestamps down below because we're gonna cover a lot of different topics for your viewing pleasure. So let's say hi to Zach from TokenTax.
Hey everyone, thanks for listening today, and hopefully we'll be able to get a lot of useful information for you figuring out your last minute 2018 taxes or preparing for amendments or figuring out how to get ahead of 2019 and things you can do before the end of the year to make sure your taxes aren't as complicated or difficult to do next year when you're figuring this out.
Perfect. So let's just jump right in. The first kind of more complex topic I want to talk about are people who don't really buy from exchanges, but do things over the counter. Maybe they're a bigger player or they do things peer-to-peer like LocalBitcoins. Can you talk a little bit more about what they need to know from a tax perspective for that?
Yeah, I think there are some interesting situations with LocalBitcoins recently, and enforcement actions taken by FinCEN, which is the organization that people have to file FBARs with, Financial Crimes and Enforcement Network, where basically there were a lot of people buying Bitcoin, especially on the exchanges, and then turning around and selling it on LocalBitcoins because there was a big spread. And the key is, just like with all trading and other crypto investing work, keep your records, keep really good records. And LocalBitcoins is good about this. If you had a lot of different wallets, you can basically track down all that data. But we've seen several people get letters from the IRS where they're basically asking about, hey, you sold a lot of crypto on LocalBitcoins, or they got the IRS letter from buying it on Coinbase and then selling it on LocalBitcoin, and maybe they hadn't reported their taxes for several years, and now they're dealing with complexity because when you're selling Bitcoin to people in person for dollars, you could be considered a money transmitter. That's a big issue that you need to think about. Yeah, basically FinCEN came down on someone who had done a lot of transactions, especially over $10,000. There's a requirement that if you're selling over $10,000 in Bitcoin to someone in dollars, that you basically report that as this is like what a bank does. If you deposit $12,000 in your account, they send a little form out that says, oh, a transaction over $10,000. And a lot of people didn't realize they have to do this when they're trading on LocalBitcoins. But basically, what you need to do is upload all of your data of your sales, and then you need to have all the data of where you bought that crypto, whether it was on Coinbase or wherever, or if you were mining it, because otherwise it looks like you just sold a bunch of Bitcoin that you never actually purchased and or never had a cost basis for. So that's one of the biggest complexities we see with LocalBitcoin. But yeah, Be very cautious on how you do that, because like I said, FinCEN is actually pursuing people for not having everything correct as far as anti-money laundering notifications and things like that. So it's more complex than people realize.
That's really helpful. Thank you.
Yeah.
The next topic I want to kind of dive into is in the decentralized finance, or better known as DeFi world. There's a lot more DApps coming out in the space. I know some of my friends have been using it for different things like compound finance, lending, getting some interest and so forth. So I can just wondering if you can tell us a little bit more about your thoughts on that from a tax perspective.
Yeah. Well, yeah. And the interesting thing, we were talking about this earlier, is, with the DeFi products, there's a lot of different ones, and it's really kind of unique to specific situations. But long story short is, keep your data, and we can figure out economically what happened and what the tax implications of that are. But yeah, like the lending out, and basically, even if the data you have isn't perfect for showing everything that happened, what the IRS really cares about is money that you made, taxes are paid on that. And so effectively, we can figure out a synthetic way to show that to the IRS and say, with all these DeFi activities, the net result was, 11 Ethereum or whatever. And so we can kind of do it that way for the platforms where the data isn't as perfect. But in general, yeah, it's a situation where the accounting isn't that complicated once you eventually figure out how much was made. And that's the most important key. But we integrate and take the data from a lot of different platforms, and especially as more collateral is let, and as these products expand, I think you'll see better and better record keeping, which will make all of our lives easy.
Awesome.
But yeah, we'll see.
And the next thing I want to touch on is something that I've actually come across quite a bit, and those are using products like decentralized exchanges or centralized exchanges, but ones that kind of closed down after a while. Can you touch a little bit about the complexities or the best practices when it comes to those?
Yeah, one of the most interesting things that's come out recently about decentralized exchanges is that FinCEN, again, the entity that you have to report your foreign exchange holdings, has specifically said that decentralized exchanges and wallets are excluded. So a lot of people weren't sure. I'm trading on a decentralized exchange. They have offices, wherever in Switzerland, but they aren't taking possession of the crypto. Do I have to report it? And so there's a clear no on that.
Oh, okay.
So that's
Did not
wonderful.
know
But yeah,
that.
a lot of these
Did not
decentralized
know
exchanges.
that.
Yeah. So, and that's something new that came out. And there's been a lot of conflicting articles written, unfortunately. But if you go to the source documents from FinCEN, they make that pretty clear. And wallets also don't need to be listed on an FBAR. And the other big thing is a lot of the decentralized exchanges, they don't really make it easy for you to have your transaction data, or that was never their intent. They're just trying to help you exchange from one asset to another. So the record keeping falls on the individual a lot of times. And same with people that trade on Cryptopia or whatever exchange. A lot of other exchanges have been shutting down recently, a lot of the smaller ones. And if they shut down, a lot of times your data's gone. So things you can do to avoid that: make API keys, keep them with a provider like TokenTax, where we're able to pull all of our customers' APIs whenever we hear, oh, an exchange is going to get shut down, so we can help them get their data out before they end up having to figure out 8 months later, oh, I don't know my purchase values for the crypto. Because even though I got my crypto out, I didn't get the data. That happens a lot. The other thing is just good hygiene on record keeping. So every time you make a lot of trades, or once a month or once every 3 months, it's really smart to just download your transactions if you can, and keep track as you go, because an ounce of prevention saves a pound of cure. Maybe we have time later, but when you're missing data, we have different options. Like we can create synthetic trades to try to replicate what was there, but obviously there's no proof of what actually happened. You have to search wallet addresses and blockchain explorers. And so what we have to do is be as conservative as possible and say, for example, with Mt. Gox, a lot of people bought Bitcoin there and then didn't have their records, but it's well, they sold 10 Bitcoin in 2015. We know they bought them all on Mt. Gox sometime in 2013. So then we have to use the minimum Bitcoin price. So they're able to get something in terms of cost basis, but it's not as good as if they had kept better records.
That makes sense.
And obviously it gets more and more complicated as you go crypto to crypto, because then you need to figure out the minimum ratio for that over whatever unknown window that you were trading. And obviously you can see it gets exponentially more complicated. But yeah, that's something we do for our VIP customers. A lot of people lost the data on Cryptopia or lost the data on Quadriga, whatever, and then it makes their taxes so much higher. So, it's pretty time consuming, pretty manual, but we can basically make synthetic trades to try to recreate whatever data was lost.
Awesome. That's definitely helpful. Okay, thank you for that. The next topic I want to move to is a case that a lot of us have also experienced, where we get crypto when we're not really expecting it. And so that's airdrops. Well, some airdrops just come to your wallet randomly, and then also forks. So can you talk a little bit about those and how we should think about those?
Yeah, exactly. Happy to. So, Bitcoin Cash is a good example of a fork where, if the two main options were, hey, just say I had $266 of ordinary income per Bitcoin Cash that arrived in August 2017, or you don't report any income when you got the Bitcoin Cash, but when you sell it, whatever you sell it for, you just report zero cost basis, so you pay taxes on the full gain. Basically, reporting the ordinary income is more conservative because you're paying the taxes up front, whether you actually ever sell it or not. But essentially, they kind of add up to this. But I think the most important thing here is that you want to be consistent. So if you're reporting ordinary income on one or two forks, try to report it on all of them and use that. And so because of that, where you get many, many forks. So we all know Bitcoin Cash, Bitcoin Gold, but there have been tons of other forks. And so
exactly.
To be consistent, it'd be pretty hard. So most people opt into just saying, I'm going to do zero cost basis. I don't know which forks, which airdrops I got, but if I ever sell any of them, if I ever actually get dollars or anything useful or a Bitcoin out of it, then I'll pay taxes on that. And that way there's a lot less burden of making sure that you didn't miss any. And airdrops are very similar. So when you get the airdrop, you can either treat it as ordinary income, or you could, when you sell it, pay taxes on the full amount of the gain. And so those are the two main, and Bitcoin Cash, the most prominent fork, was interesting because a lot of people in the US had their Bitcoin on Coinbase, which specifically said, hey, we're not going to support Bitcoin Cash. You're never going to get it. So it'd be a pretty big leap to report that as income for them in August, when just magically it got dropped into their wallet in December 2017.
Right.
So to go retroactively back. So there are a lot of problems with reporting it as ordinary income, but that is the most conservative treatment. So if you're someone that's like, I just want to be as conservative as possible, ordinary income is probably the way to go.
What are your thoughts? I've also read on some articles about like those random airdrops that we get in our Ethereum wallets. Some people were saying to count those as gifts. I was wondering what your thoughts are on that.
Well, that wouldn't change your taxes at all, basically.
Okay.
But, you know, a gift like, hey, my mom bought this Bitcoin and then gave it to me. What you need to know for gifts in general is what your mom paid for it or what your friend paid for it, because that cost basis goes with the gift.
I see.
A lot of people think, oh, it's a gift. It's like, well, that's not really what a gift means for tax purposes. But either way, you know, the cost base is still going to be zero when you sold it, because it's not like they spent money and then gave it to you.
That makes sense.
One big thing that people don't realize too is that, hey, if you get a gift from, well, since you brought up gifts, if you get a gift from someone, it's not the value when they gave you the gift, it's what they paid for it. And so if they paid nothing for it and they gave it to you, the cost basis on that when you sell it is still zero. You know, you can't use the value when you got the gift. That's incorrect, because no one's paying taxes on the appreciation between when they got it or whatever and when they gave it to you, unless you're inheriting it. So if you inherit something, you inherit it at the market value. That's the only exception of that. And same with your home, same with things like that. So, you know, that's why wealthy people, really wealthy families and billionaire family, they never sell anything, because you get such a big advantage by holding these assets. You know, move out of your house and then rent it out, as opposed to selling it. You know, they just accumulate assets and then they're all inherited by the next generation at the stepped up cost basis, at the market value at the time of inheritance. So
interesting.
That's a personal finance tip to drop in.
Thank you. So the next thing I want to move to is definitely something a little bit more complicated, and that's staking. Especially important since Ethereum is moving towards staking. So probably a lot of people are going to start doing that, as well as masternodes, which is kind of similar, also a staking approach.
Yeah, exactly. I mean, long story short, you can think of that as ordinary income, you know, especially if you're actively deciding, hey, I'm going to stake it. That's a little different than I had for Ethereum and I got some airdrops. Even though in effect, it kind of feels the same. You're getting something with some value, but staking, usually you have to you have to opt into it. And then let's say you over the course of a year, you got a little bit of Ethereum every month. Basically, you just need to know the timing and the amount of when you got it. And then our price database looks up all of those receipts and knows what the dollar equivalent is. And then at the end of the year, it's like, all right, so you had $1,100 in staking income. And that's taxed the same way as ordinary income. Like if you got paid a 1099 for being a consultant or a web developer or something, all of that is ordinary income on your staking. And same with running a masternode. So, but the thing is, you can think of it as its own business. So if you had to spend money to, let's say, hire someone to teach you how to set up that masternode, that can be an expense against the income. Or if you had to buy a special computer or whatever expenses you had to have. So one big thing for taxes is keep really good records of any amount of money you spend to earn these types of income. Because what will happen is people say, well, I made all this money mining, but they haven't kept track of what they spent on electricity or on hardware or things like that. And so, you know, think about that. For staking, there probably really aren't that many expenses, but if you had to buy even a tutorial or a book or whatever that taught you how to do some of that, that can be offset against the income. So that's a little way to save some money on your taxes.
That's a great tip. Thank you.
Yeah.
The next topic I want to talk about is something that I also haven't ventured into. It's margin trading. I guess, can you tell the folks who are listening who have done margin trading how they can deal with that?
Yeah, margin trading is interesting. I mean, in a perfect world, you know, and like E-Trade places like where the records are really good, it's actually shouldn't be that hard from a tax perspective. The problem in crypto is that the exchange is providing data on the margin trading. The data is so bad that it's hard to tie in, you know, the position you opened, the position you closed. It should just be like a regular trade where you add a gain or a loss and we report that. The problem is it's very hard to tie those two together. So like BitMEX just gives you a daily P&L. They don't link up the transactions except for, you know, important clients who they'll make a special report for. Poloniex is even worse. Thankfully, they stopped allowing margin trading in the US because the record keeping has been such a nightmare for so many people. You know, Bittrex, it's very hard to see how you did on individual trades with their regular ledgers file, because they put like, you know, an aggregated margin gain or loss for certain positions. So long story short, every exchange kind of reports it differently. It might be really hard for a non-Excel wizard or non-accountant to really figure out exactly what happened. And if you have mistakes there, you could end up overpaying your taxes by a lot, or you might mess it up and underpay your taxes. And then when the IRS takes a look at the raw data or whatever, they're going to realize, hey, why was only this amount paid? So all that to say, the margin data, that's the most complicated thing we deal with, what our accountants spend a lot of time on, because most of it needs to be done manually. Whatever exchange provides enough information. In many ways, it's like going short too, which makes it complicated. Like you'll put up some collateral, crypto, and then you'll go long Ripple, short ETH. And so what that actually looks like in an accounting transaction way is you sold Ethereum you may or may not have had, because the collateral allows you to take positions where you're short crypto. So the long and short of that is that it might look like you bought crypto after you sold it, which is not normal. And so we try to firewall that data so it doesn't cast suspicion on the rest of your data. Got it. But yeah, margin, you know, go in with your eyes open, because the accounting could cost you quite a bit at the end of the year to make sure to get it right. And if you don't get it right, it could cost you even more. So it's one of those really tricky things. We'll see. Yeah, Binance is coming out with margin trading as well. So maybe they'll do the records better and do them right. I don't know. We'll see.
Hopefully.
Maybe.
Awesome. Yeah. Okay.
Hopefully.
And the next topic I want to talk about is something that I believe the rules have changed for maybe once or twice. So it'd be good to hear from you what's the latest about lost or hacked funds per se. Either you lost something or someone hacked your private key or an exchange. What's the latest rule about how to handle that?
Yeah, it kind of depends on, again, it's like our tax code is so complicated. There are so many different arguments that can be made, but one of them is casualty losses. So basically, and that's the same if there was like a hurricane or things like that, or if your car was stolen, but those were disallowed starting in 2018 for individuals. But back in 2017, 2016, if you had crypto stolen, you could take a casualty loss over some threshold. And then if it was like a high enough amount compared to your income, you could get something for it. But now that's been disallowed for individuals. So, you know, some people try to invest through a business so that it can still be some type of deduction, or they take it as Schedule A deduction is what it's called, like property held for investment or for business investment. That's another treatment. And then the other thing that can be done is take it as a worthless security. And so that's a bit more of an aggressive treatment, because you're writing it off as a capital loss. And unfortunately, let's say you put $10,000 into Bitcoin, it goes up to 20,000, then it gets stolen. If you write it off as a worthless security, that's still only a $10,000 loss. It's not the market value. But yeah, I mean, it's crazy out there with SIM swapping. You know, I was also a victim of SIM swapping, and be careful with your crypto, because people known to be in crypto are being targeted by these hackers who can impersonate you. And just, you know, it just happened to Jack Dorsey, the CEO of Twitter. That's how he got his Twitter hacked. Right. You know, they basically just have inside people at AT&T and T-Mobile, and they say, hey, I'm Jack Dorsey, give me a, or they just contact their inside person, issue a SIM card, pop it in their phone, and then they can override to access your email or access your crypto accounts. So you need to make sure to remove your cell phone as a recovery method from your email, from your crypto accounts. So that's PSA that, yeah, and avoid having to deal with the tax stuff afterward. But basically, there should be a way to find a way to, in your taxes, to get something for lost or hacked coins. But in a worst case scenario, if it happened in 2018 and you try to take a casualty loss, you get nothing for it, which is really crazy. It's just adding insult to injury, unfortunately.
Yeah, exactly.
So
awesome.
yeah,
well, hopefully people
figure it out.
Hopefully people follow the best security practices and don't fall for that. But TokenTax can help if something happens.
Yeah, a lot of people think they have great security, but take your phone number off as a recovery method or an override from your email, from your bank accounts, from your crypto accounts. Like, people don't realize two-factor is not enough. Two-factor to a device is not enough if they can just override via text message. So I hope that's a useful PSA.
Awesome. And the next one I want to talk about is the people who have like software they buy for trading and like bot trading, high frequency or whatever, that just do a lot of order routing and one trade becomes like 100, and then they end up at the end of the year with like tens of thousands, hundreds of thousands. How can you guys advise them and help them on that?
Yeah, I mean, part of it is, if you're doing this as a trading strategy and you've identified some type of algorithm that, you're making a little bit of money on each trade, just make sure to factor in the cost of doing your taxes at the end of the year and figuring out your proper gains and losses, because, we've seen, if you have 4 million transactions, like it can take weeks of breaking that into smaller pieces and running the data, figuring out the gains and losses in chunks that need to be reported in smaller pieces. But basically, long story short, figure it out with a smaller amount of data to make sure that it's even possible to figure out your gains and losses, because these are the worst situations I've seen with the IRS, where someone's data looks like they made $50 million, but they actually lost 80,000, but they have so many trades across so many exchanges done by bots, and then they were using their own software they created to write transactions, and they really have no proof that they didn't make all that money. And obviously that's a bad situation to be in with the IRS. So, make sure that the most important thing about this is that you're making money. But the second most important thing is that you can prove how much you're making and that it's not looking like you're making way more, because that can get you into a nearly impossible situation many times. But yeah, a lot of people just write a bot. They think it's fun. They start trading and they don't realize how crazy it's going to be to unwind all that and figure out what happened. And usually the data says they made a lot more money than they did, because they have a lot of missing cost basis. When the timestamps, different exchanges report timestamps differently, or here's it like Bittrex. If you have open positions and you're selling a little bit of each part, it won't show the date of the trade being closed until the last part is closed. But a lot of times that results in missing cost basis, because they sold they got crypto from that trade and sold it to buy other crypto. So before you get too crazy with the bot trading, take a look, drop your data into TokenTax or crypto tax software, and make sure that it's all looking fine and getting processed, because that can be a really difficult thing to deal with a year and a half later or 2 years later.
Yeah, great advice. Okay, just two last topics. The first one is, so some people have bought tokens before and just hodled them for a long time, and now they've been delisted from exchanges and there's nowhere to trade them. What do you recommend for those?
Yeah, it was definitely devastating for a lot of people who made a lot of money in 2017, then lost in 2018. They lost some, and they come to us and they're like, hey, I have 30,000 in crypto, but your software is saying I had a $50,000 gain. How is that possible? Like, the software is broken, And what they don't understand is, in accounting, there's realized gains and unrealized gains, and realized losses and unrealized losses. So, they have the realized gains from, let's say they sold Bitcoin at the beginning of 2018 when it was high. They bought into some ICOs or to some illiquid tokens, and those tokens just dropped and lost 99% of their value, and there's nowhere to sell them. So they just said, people stopped thinking about it and they never sell it. And then it's not a realized loss. So, they put 30,000 in, it's worth $50 now, but they never sold it. So now they don't actually get the tax savings for that. So you have to find a way to dispose of the asset. So, and you can't really sell it to your friend or your wife, because you have to make an argument of like arm's length and all this. So like, as a courtesy for some users, we've been buying or letting them pay for a crypto tax package, part of that with like a nearly illiquid, so that they can actually get rid of custody. They have a strong argument, because the most important thing for them is that, they have disposed of it and it is a realized loss at that point. So for one, before the end of 2019, if you have any situations like these, like zombie tokens that are not actually worthless, but it's really hard for you to sell, find a way to sell it to someone or figure something out so that you can realize the loss and at least get part of that money back as a shield on your gains. And yeah, that would make the biggest difference to people's taxes. Out of all the topics that we've talked about, people not realizing they have to sell their failed investment tokens or illiquid tokens to get the realized loss is one of the biggest problems we deal with. And there's no way to go back in time and do it. But losses don't carry back. So if you had really big gains in 2018, paid taxes on them, really big losses in 2019, those losses just roll forward. So it's really important to do this in a timely way. So yeah, come and talk to us about tax loss harvesting in November or December at TokenTax if you have any situations like this, and we can guide you through it.
Awesome. And the very last one is, I know there's been kind of increasing interest, and I've even heard of some people in my community talk about investing in like a Bitcoin IRA or putting some of their crypto into a 401k plan. Can you talk about the tax implications, if any, about that?
Yeah. So there are some providers of Bitcoin IRAs and Bitcoin 401ks. Basically, it's kind of like any self-directed IRA, and all the ones I've seen so far have pretty high fees. So it's hard to recommend how many that I've seen, but anyone out there who has one they think is a reasonable option, feel free to send it over. But my biggest thing on investing in crypto with your IRA is that's probably not a smart decision from a financial literacy and just understanding what you're doing from an investing perspective, because cryptocurrency is a riskier investment than a lot of other investments. And so that retirement money is kind of after tax in a way. So it's a bad idea to waste that, in my opinion, on things that could go down, because at least the good thing about investing with your regular dollars into cryptocurrency, if it goes down, you get a tax loss for it and you get a tax shield. Buying risky investments with your IRA, and this isn't just crypto, but anything with an IRA, if it goes to zero, you get no tax shield for it. So IRAs are best, in my opinion, for investing in like REITs, real estate investment trusts that have high dividends. So you're getting a lot of interest, basically, or dividends that you pay high taxes on. But now in your IRA, in your retirement account, it's tax advantaged. It might be completely tax free. And so, my own personal IRAs, I invest in things like that, like very stable. They're not going to lose their value, because if it loses value, you get nothing for it. If it keeps going up, you don't pay taxes on the gains. So what I would say is, if you have a really strong investment thesis, like, oh, I know this token, I know it really well, for whatever reason, you're very confident it's going to double, that type of thing. Okay, well, then yeah, invest in your IRA, because then you won't pay taxes on that stuff. But like, a lot of people think it easy, like if something's that easy, really, really, really triple check that it's as easy as you think, because there aren't that many things in life that are that easy. But if, for whatever reason, you're very confident, that's maybe worth investing with an IRA. But for the most part, people wanting to buy crypto with an IRA, I think it's a bad idea. I think you should buy more stable, high yielding assets as part of like a balanced portfolio.
Got it.
If that makes sense. And,
yes.
we do this type of wealth management planning. We're not just crypto taxes. We help people with their entire tax returns, their entire investment portfolios. And, going back to your last question about these illiquid tokens, a lot of people get paid in crypto, for example, and they can't just turn around and sell all the crypto they got, or tank the market. And they might get paid $50K worth of crypto for their marketing company. Mm-hmm. But realistically, we need to make an argument that it was only worth $20K, because after that, the price dropped a lot and they weren't able to sell it. And so this is something we do for anyone who gets paid in crypto. I know you probably do as well with Bitcoin for Beginners, but you may be able to make an argument that the crypto you received wasn't worth the exact US dollars value that if you look up in CoinMarketCap, or if the IRS looks it up. And you need to hire a tax professional to really give the valuation in a reasonable way of, hey, this is only worth 30% of what CoinMarketCap says. But that's one of the most important things for people running crypto businesses, that they don't realize. There is an opportunity to argue that the income you received wasn't actually worth what an open market value would say. And same for people mining crypto, especially these illiquid and obscure cryptos that maybe weren't worth what it said out on CoinMarketCap.
That's an amazing tip. I actually never knew that. So thank you for sharing that.
Perfect. Yeah.
The last few questions in total, I think we're done with the more complex scenario ones. I want to move to one where, let's say someone has been a trader investor for a couple of years now, and their records or what they've been doing hasn't been the cleanest. What's maybe like one or two general tips you can give them so that they can start getting a cleaner and a healthier approach?
Yeah, I mean, first thing I'd say, if you've been trading for many years and your data's a mess, you might have got a letter from the IRS that says, under penalty of perjury, you need to affirm that all your tax returns are correct. And people are panicking and really, really depressed and feeling terrible. And what I would say, number one, is just relax, breathe. It's okay. The IRS, I think, understands how complicated this is and that there's missing data. Just get help if you're that concerned about it, from a professional. And like I said, we can fill in the gaps of missing data with synthetic trades. At the end of the day, what really matters to the IRS is that taxes are paid on the gains and income you had. That's the bottom line of everything. So if you can figure out how much fiat went in and how much value it has today, like how much fiat you took out plus the value of the crypto, that arc, whatever the timing, 1 year, 3 years, 4 years, as long as you can prove what went in and what you have today, we can work backward and fill in the gaps. And it's okay. So I'd say, number one, breathe and relax. It'll be all right. It'll be sorted out. I know it's very scary. And number two is, an ounce of prevention saves a pound of cure. It's hard to go back in time and fix this stuff, but it may require a lot of time. But going forward, like I said, download your transactions after you make a whole bunch of trades, download your data. Just in case the exchange disappears the next day, you never know in crypto. And quarterly, put a thing in your calendar. If you trade crypto a lot, put a thing in your calendar, March 31st, June 30th, September 30th, and December 31st. That just reminds you, hey, go take a snapshot of your balance and download the data from the exchanges you're trading on. And if you're on that many exchanges where it's a lot, then have API keys and have a company like TokenTax and say, hey, I want you to pull my data every day, every month, every year, whatever, to make sure that it's all somewhere just in case the worst happens. And, and like I said, don't get too down on yourself for not keeping good records, because it's very common. Almost everyone we see who is in crypto back to 2014, 2013, 2015 has missing data. And some people are more worried about it than others. But what really makes me sad is when people are actually like depressed and super stressed that it's affecting the rest of their life. So it's not that serious, and it's a serious thing to be dealing with the IRS, but we can figure out a solution. So hopefully anyone who's feeling really nervous and stressed, that calms your nerves a bit.
That's great to hear. I'm already calmed, even though I haven't received any letters. Thank you. And I think the very last thing I want to ask you is, we've gone through this whole discussion right now, and people might have heard about TokenTax a couple times here and there from what you shared. But can you give us like the biggest take-home points for these traders, investors in crypto about your product or service that you want them to know?
Yeah, definitely. So, TokenTax got started in 2017 in the Product Hunt Global Hackathon, kind of as a beta product and more of an idea. And we ended up winning first place out of like over 1,000 companies entered in that. But the big thing, there are several crypto tax software providers, but and there were a lot more a year ago. A lot are disappearing. But so I'd say the big things about TokenTax is, we're built by engineers, but also by accountants, and we have the whole accounting side, CPA. We file full returns. We can go in and we can use like the IRS principles of conservatism to figure out how to fill in synthetic trades and fill in missing data. We work with individuals, kind of like TurboTax for crypto tax, where you upload your data, it does all the magic, and you just download what you need. But also we work with funds, with businesses, and figure out really complicated crypto tax situations. So, sometimes people come and say, hey, why, there's one software that'll do my Binance for $10 or $5. Why are you charging $65? And the answer is, well, we have accountants looking at your data, answering your questions, and it costs money to pay the team on that. And so, it's more of a value product though. And we have minimization algorithm. We teach you about specific shares accounting. And our goal is really to create value for our customers. Like, we like to think of it as, hey, they have more money in their bank account at the end of the year because they hired us than if they had gone somewhere else. So maybe we cost a little more, but we actually create value by teaching you, hey, you can do this on tax loss harvesting. And so in the end, that's why we have such high retention rate with our customers. But, come check us out. If you have any questions, we're happy to answer them. But yeah, tokentax.co. And we just love helping people figure out complicated crypto tax situations. And it's really nice when people are extremely stressed, and then after working with us for a couple weeks, they realize, hey, all this is figured out. I know how much I owe, or I'm back in the good graces of the IRS. And a lot of our customers have gotten these letters, have gotten audited, things like that. So we've seen all the complicated situations. So don't worry, there's professionals out there who can help you no matter your situation.
And I just want to add a really quick note. I can vouch for how helpful they are. Like, I've had a little bit of, maybe not the most complicated situation, but I've talked to people on your team, and they've helped me through chat for like the 3 weeks I spent diving into my data. They helped me know where to look and which parts of your software to look at different times. So that's really helpful. And last thing is, what's the best way for people to reach you if they have questions right now?
Yeah, we have our Telegram group at TokenTax, but the best way to reach us is come to tokentax.co. Bottom right of the screen, we have a little intercom chat, and we always have people on there pretty much 24/7. And you have the whole team, Devin, Sam, Oscar, I'm on there, Alex. So, there, and if your question is really complicated, it can be escalated the right way. We can set up a call, whatever you need. But yeah, intercom is our go-to place to get any questions answered you have about crypto taxes, about our software, about uploading data, timing. And yeah, everyone, it's going to be pretty crazy for the next 10 days, but make sure that you file a return by October 15th, because if you don't, you could have a 5% failure to file penalty. So even if everything's not perfect, try your best to get it right, file something, and you can always go back and amend. You have 3 years to amend your return, even if you overpay, and you can get back all the money. So make sure you get something in by October 15th. And yeah, come talk to us on Intercom, or you can also find us on Twitter at TokenTax, or on Facebook as well.
Awesome. This was really helpful. I even learned several things I didn't know before. Thanks for
Awesome.
thanks for joining us, Zach. And everyone, like he said, go visit tokentax.co and leave any comments down below as well, and I can help direct you to the right place.
Thanks so much for hosting me, Kevin. It was my pleasure.
Thank you.